Hey guys, I'm Hunter with Nelson Insurance. I'm going to go over just the basics of captive insurance. Like, captive insurance is going to be something that you guys are going to hop into when you guys are really paying a good couple $100,000 in premium. Now, you can start off when getting into it if you're only paying 100, maybe 250. But really, this is the next level towards that self-insured, really starting to get those rewards of being a clean risk, of knowing lowering your cost of risk, of really evaluating your whole book on the sides of insurance. And I'm not saying just the premium. So with captive insurance, the simplest way to explain it is like buying a house versus renting a house, right? Now, if you're paying, I'm going to use the house metaphor. If you're paying $2,000 a month in rent, that money is going to the landlord, and you have it for, momentary until you find something else, and you're just basically paying to live there. That money is not appreciating for you. None of that money is going towards you, anything along those lines. Now, when you guys buy a house, now you start taking on some of the risk, right? So what happens if you need to replace the roof? When you guys rent, you don't need to replace the roof. What happen? And then you guys start paying your mortgage. Well, now instead of $2,000 going to the landlord, now some of that money is going to the equity of the home. Some of it's going to interest. And, if you can manage your cost of risk well in the home, like keeping up maintenance and everything on those lines, you're going to make more money owning a home than renting a home. That is just the simple math of it, right? Now, obviously, I'm not talking about renting a $500 apartment and then buying a $10,000 a month mortgage. Obviously, those are two completely different ballparks, but I'm saying if you're paying about the same amount there, it 100%, you are going to be keeping a lot more of your money if you are owning a home. Now, the same thing applies to captive insurance and going through the marketplace, which is just your everyday normal insurance, right? When you have your normal everyday insurance, you pay your premiums. They go to the insurance company. You get nothing in return for that. There is no, oh, hey, we're very profitable on you this year. You didn't turn any claims. Here's some of your money back, or anything along those lines. It is just that. But there's also less risk to it. Now, you might have a $2,500 deductible or maybe $5,000, but that's all the risk you got. If there's a $50,000 claim, don't worry about it. Insurance company's got it. That's what you're paying for it. That's what you're paying for, right? Same thing goes with renting a house. Now, when you guys are hopping into captive insurance, you be starting your own insurance company. You be starting your own insurance company or joining an insurance company where you become the owner of. And I'm going to get into the difference between captive or group captive insurance and single parent captive insurance. And this is really just a basic overview. So you're hopping into a captive, right? You start paying those premiums, just like owning a home. Some of it's going to go to the captive fee. Some of it's going to go to what's called your fund. Well, it's going to go to the fund. You got A funds, you got B funds. We want to keep it simple here. And if you guys are paying in that money, you're roughly about 35% is going to go to managing the captive, to make sure the business is running, the insurance company is running, everything on those lines. And then the rest of it is going to go to your fund. Now, if you are paying $1 million a year in insurance and you turn in $500,000 in claims, right? Now there's $500,000 left over. Some of it is going to go to the captive, and some of it's going to stay in your fund, and it's going to earn interest. It's actually going to appreciate. That money is going to earn dividends for you, and that money is going to stay there for next year. And every single year, you pay in $1 million. You have some of it go to the captive. I'm saying 35%. It could be a lot less than that. 35% is a little bit on the high side, so I'm just giving out a number there. And then the rest is going to keep going there. You're going to keep building up this fund. It's going to keep earning interest. You're going to keep earning dividends. And now once you got that, you can start earning some of that money back. It's still your money, right? And so it's exactly like buying a house versus renting. You get some say in this stuff. Now, when you guys go make investments in safety, in compliance, and everything on those lines, really when it comes to the everyday marketplace insurance, you guys just have an ELD discount. You have the basic stuff, right? But if you go invest all this money in anti-collision and hardware and all these dash cams, and the insurance company may give you a discount, it may not. I had a guy telling me he spent $9,000 on all of his trucks, and they got like 60 trucks. Insurance company have a single discount for the whole thing. Well, holy crap! You just invested $450,000. Yeah, my math's right there. Well, as for 50 trucks. we'll call it 50 trucks. 450 grand for 50 trucks, and you just saw no premium decrease or total cost of risk really go down there, right? So your insurance might go down because the claims go down, but other than that, you really got nothing. When you guys go into the captive side, if you guys invest this money into lowering your total cost of risk or just lowering your risk, that means less claims be turned in, less out of pocket for you guys, and more is going to be going into your fund. So now here's the bad sides of a captive, right? If you guys are paying $1 million in insurance and you turn $3 million in claims a year, it ain't going to work out for you, right? It's not a good fit, because when it comes to captives, you're going to have basically like a massive deductible. It's going to be a self-insured retention. When are you going to pay out a claim before the insurance company steps in? And so you might see this around $300,000. Every claim below $300,000 or $300,000 for the year, however it's set up, you guys are going to pay out of pocket. So you got to be somewhat liquid and have some money set aside there. And if you turn in $3 million in claims, obviously none of that's going to reserve. Captive goes way up, you're probably getting kicked out. And so that wouldn't work out for you. And on top of that too, if you can, hey, I'm paying $500,000 a year, but I don't have a couple $100,000 laying around just in case. Well, you can kind of see what that stuff looks like, and maybe it's not a good fit, because starting a captive is investment. It's just like a home. You got to have a down payment for a home. You don't have a down payment when you go rent, but you do have a down payment for the home, and you go do that because it's an investment for you, right? So the same thing goes with a captive. That is why obviously most people wait until they're a little older to buy a home, because they got a down payment. Most people wait until they've been in business for a while and they've got a big company before they go into a captive. So there's kind of the basics there. You have two options really when it comes to captives. You have a group captive, you have a single parent captive, and there's a bunch of other like little nitty gritty stuff, rent a captive, all sort of stuff, right? A group captive is one that's much easier to get into. There's going to be a premium threshold where it makes sense to get into it and even just be accepted into it. But that premium threshold is going to depend on the industry you're in. If you guys are in construction, it might be $100,000. Trucking, they will start at $250,000. Some are $600,000, but there's different group captives out there. When you guys hop into a group captive, I'm going to use Gibraltar for an example. Gibraltar is a $250,000 bare minimum entry premium to get into the captive. And when you get into that thing, you are going to be a partial owner and be on the board of this group captive with, let's say, 20 other people. So you have 20 other trucking companies, and they got to vote you in, and then you'll do the same once you're in there. Because if you see a guy that turns in $3 million a year in claims, pays $1 million in premium, you're going to go, this dude's going to suck all the money out of the fund that I'm part of. That's my money in there. I don't want this guy in here. And so you get that group, and it's a little more spread out on the risk. Now, some people are like, hey, I don't want partners in my business. I don't want people telling me what to do. I don't want anything along those lines. I want a single parent captive. I want to be the sole guy in that captive. I want it to be my insurance company. This is my deal. I'm the only one in here. I don't worry about anybody else's risk affecting my money. Now, if you guys do a single parent captive, you got to have a lot more money. This is why there's multiple people in a group captive, and it's lower barrier to entry. A single parent captive, you typically got to be paying a bare minimum of $2 million a year to get into this. National Interstate is one of the best out there for single parent captives, and they kill it really good. A lot of people try to get into a captive when they can. One last thing I'd really probably say on a captive is captives are becoming very popular. A lot of people think, everybody thinks, 90% of the people I talk to think insurance is a scam. They're making buku bucks off of me. I can't wait. I would so rather self-insure myself, right? I just think about myself for my business, my auto insurance, my home insurance. Also, I've never turned an auto claim. I've never turned in a home claim. I've got a couple $1 million in umbrella coverage. Never been sued. This stuff, like, the insurance company's making money off me, right? But you got to remember that you got to keep in mind that these insurance companies are not making buku bucks. And it doesn't mean the second you're going to instantly make money going to captive. This is a big decision. You got to really make sure that this financially makes sense for you guys. And a captive is not always going to be cheaper than the insurance marketplace. So it just kind of depends out there. But I would say most of the time, a lot of the time, captives are going to be cheaper, especially if, like I said, you have a low loss ratio. You turn $1 million in premium, you pay $500,000 on claims, you have a 50% loss ratio. You scale it back 5 years, how much you paid in, how much has been paid out, that's your loss ratio. If it's below 65, 100%, probably makes sense to get in a captive. You're above 85%, probably not making sense. Probably a good idea to stay in the marketplace until you can prove that you're making money in a captive. So I know a lot of you guys out there watching this this is not meant for everybody. There are very few companies out there who are big enough and really make sense to get into a captive. But if you guys do have any questions on this and it does apply to you, feel free to reach out. Again, I'm Hunter with Nelson Insurance. I'm the owner here. We're in Sioux Falls, South Dakota. And appreciate you guys watching. So if you guys would, like, subscribe so I keep making content like this.